Should you invest in stocks, bonds, or real estate? With so many places to invest in, you have a lot to consider because you have a finite amount of money to go around.
Therefore, to help you make a decision regarding the best place to put your money, we want you to calculate something called return on investment, aka ROI.
Today, we're going to teach you what an ROI is, how to calculate it, and how to tell if something could be a good investment for you. What's up, people? It's Nadia
And Nicole,
bringing you another installment of the Wealth Twins Show.
Yes, where we give you the best tips, tricks, and tools and inside scoops on how you can build your wealth on a road to financial independence.
And what does that mean, Nicole?
That means we're trying to make work optional for them.
AKA fire your boss.
Yes.
So if you like what we're doing here, make sure you hit the subscribe button and the notification bell so you can be notified when we have a new video coming out.
We're releasing them every week, but you don't know what day. So we want you to check it out.
All right. So Nicole, let's get started. What's an ROI?
ROI stands for return on investment. It's a pretty simple calculation that can help you a lot when you want to decide what you're going to invest in. All you need to do is a simple calculation. You're first going to need to know what your initial investment will be, right? And then you're going to need to know what either your selling price will be and the amount of time you're going to need to do it. So, quick way to estimate it, let's give an example. 1, you buy a stock for $1,000. Then you sell it for $1,200. After that, you can just do a minor calculation. It ends up being a $200 profit, which turns out to be a 20% ROI, a return on investment.
All right, so let's make that a little easier for them. I think what you're trying to tell them is like you take the potential profit or the actual profit.
It could be actual or potential.
Then what do you do from there?
So what do? You take what your initial investment be, say $1,000. Someone wants you to invest $1,000 in something. You take that and they say, well, if you give me $1,000, I can give you $1,200.
Okay.
Now you can either do that by estimating, or you can actually sell whatever it is, whatever the sell price is. Say you bought a stock. You bought the stock for $1,000. Today it's selling for $1,200. If you sold that stock today, you'll make $200.
Okay.
That $200 turns out to be 20% ROI.
Okay, and for people who are not so familiar with stocks or buying stuff like that, let me give you a more familiar example.
She says I'm too complicated, but that's okay.
Yeah. So let's say these people who are waiting online for the new Jordans, which I would never do, but if you do, it's a good investment. All right, say you buy these new Jordans for $300, right? Then you decide, okay, 2 years from now, I'm going to sell them for $500. Mm-hmm. So what you do is take the $500 you think you're going to get, minus the $300 that you paid for that, and then you divide that by the $300 that you put down.
Yes.
So if you do this quick calculation, that ROI is 66%.
66%. So
that's a pretty good
Yeah, I can understand why sneakerheads might want to wait outside for a little bit.
I might wait outside. Yeah, no, maybe.
Now, why is ROI important?
Yeah, why is it important? Well, basically, you use ROI to decide if you can best use your money.
Where to best use your money, because you have a lot of options.
Yeah.
Right? You're going to see people you get hounded all the time. You can get hounded on infomercials. You can get people asking you for loans.
Yeah.
You can decide in terms of businesses, real estate, anything. Where should I put my money for me to make money? That's what we want. And since we have a finite amount of money, but limited opportunity when it comes to investment, this helps you narrow down what would be most likely a good place to put your money, and where you can make a profit or even lose.
Yeah, it's a quick way to determine which projects will waste your money if you're going to put money into it and you won't make a profit. This is a quick way to chop them down and say, okay, take all emotion out of it. Let's use math. Let's make the right decision based on math. Okay? You also could use ROI, like if you're an entrepreneur like we are, to determine if a business decision is going to be a good one and whether it should be repeated or not. Let's say you wanted to start marketing a new business and you start buying flyers. You put $500 for flyers for your store, but the people who saw those flyers and came into the store based on those flyers and purchased from you, their purchases only added up to $100. Now, was that a good use of your money?
No.
All right? So when you do that, you need to compare stuff that is using your money based on what you invested in.
Yeah, and you wouldn't go out and buy flyers again because you spent $500, made $100. That's something you shouldn't do over. Okay, so it just gives you a way to say, is this the best use? Is a way to use my money correctly, or the best way to use it?
Yeah, and how long you should hold that investment to see if it's an opportunity you should go for, right?
So with that, when it comes to different investments, it's not just about the ROI. It's also about how many years, like Nadia mentioned, how long you're going to keep this investment.
Yeah.
So with that, you want to calculate something called the annual rate of return so that you can compare apples to apples and not apples to oranges. So if something says that you can get a 20% ROI, but it's at 5 years from now when you get your money back, versus something that says you can get a 30% ROI in 1 year, you want to make sure that you're comparing apples to apples. So you want to put that on a per year basis. So the one that's 30% a year is actually a better ROI for you.
Yeah, and another thing you can consider on top of our is when you come to choosing the best place to invest your money is things such as your risk tolerance and the time it takes to actually get your expected return back on your money.
So there's other things that have to come on top of ROI, but ROI is a good way to start so that you know what you're doing, okay? Now, when we talk about annual rate of return so we can compare apples to apples, another thing that's really useful in determining the ROI and also just investments in general, if it's a good idea, is something called the Rule of 72. Now, the Rule of 72 is used to see how long it would take for you to double your money on an investment. Right?
All right, before we even jump into the Rule 72, I'm going to take a sip of coffee. This coffee is great. It's sponsored by McDonough Cafe today.
McDonough Cafe is Nadia's cafe, if you don't know. I do have to say they probably make the best coffee I've had. I'm probably now a bit of a coffee connoisseur, so I give her credit on that. Well,
Right. So let's jump back into
that coffee break.
calculating the Rule of 72.
Okay, so to calculate the Rule of 72, you just need to know the rate of return, okay? So you just divide 72 divided by the annual rate of return, and that'll tell you how long it takes for you to double your money on any investment. So, for example, what do you want to, since I'm so complicated, give an example.
Yeah. Say I have $1,000. How long would it take me to get $2,000 back?
So, calculating 72 divided by 1,000 will give you 7.2 years. It will take you 7.2 years to get double your money. If you gave me 1,000, I'll give you $2,000
That's
back.
what if you have a annual rate of return of 10%, right?
10% annual rate of return, you're
let's
right.
keep the numbers. So you need your annual rate of return, and then you have your initial investment, and then you know how long it will take you to double your money.
Yes.
So just to give you that example, again, if I had a 10% annual rate of return and I gave $1,000, I'm expecting $2,000 in 7.2 years.
Yes.
Right.
So the higher the rate of return, the shorter time it takes for you to double your money.
Yep.
Yes.
And to even make it easier, just think of someone saying, "Hey, I'll give you $300. Give me $300, and I'll give you a 10% return." In 7.2 years, I give you $600. All right?
Exactly. So those are three calculations that can all be useful in terms of calculating a return on investment. Now, you might be thinking to yourself, well, with all these numbers and what you're saying, ROI and stuff, well, I guess if I take on higher risk, that might mean I'm going to get higher return. But that just isn't the case.
No.
I wish it was the case, but it's not.
It just means that you don't really care about the risk of losing all your money. You just want to see if you can hit it out of the ballpark. For example, people do this, they're usually gambling. Okay?
Now, you ever see people when they play, just slot machines or even a high-stakes poker play?
Yeah.
It's not about the risk. They know the risk is very high, but they're not caring. They can lose all their money on the table. They're mainly concerned with how much can I get if I was to, what can I do with all this money if I win? You know?
So now, if you're not interested in gambling, you might be asking yourself right now, then what is a good rate of return?
Now, rate of return, a good rate of return, it basically depends on whatever economic environment we're in. Right now, interest rates are quite low. So banks are actually, offering CDs are around 2% for a year
You're
CD.
paying nothing.
Yeah. So if a bank is giving you 2% on a CD, then companies like any corporation is looking to issue, say, this is not true, 1-year bond, knowing that the interest rate that you can get out of bank is 2% and Fed rates are still low too, they're not going to give you that much higher of a rate, even though you're getting a little bit more risk with them. Because they know if they give you a 5% interest, right, you're going to flock. Everybody's going to flock to their bond. So a company's going to say, what is the lowest rate I can get away with to attract buyers?
Yeah.
So you're going to get a bond from a company just a little bit higher than what you will get at a bank. So that risk that you're taking is still not going to be that high because in terms of return because of what the economic environment is right now.
Yeah. And if you look at stocks, which are considered like the riskiest of the traditional assets, will offer a higher rate of return so that you can choose them over bonds and CDs.
So now when you ask what is a good rate of return, taking into account the economic environment that we're in,
Yeah.
you want it traditionally, a good rule of thumb is to go above, get an ROI that's higher than inflation. Now, based on usinflationcalculator.com, inflation actually hasn't gone above 3% in over a decade.
Yeah. So since you have a limited amount of money, you want to keep in mind ROI to help you take advantage of the investment opportunities you have and allow you to maximize your return.
A good ROI is based on economic environment and changes all the time, but a good rule of thumb is to try to invest somewhere where the ROI beats inflation.
Yeah, so the next time someone asks you to invest or even asks you for a loan, calculate that ROI before you say yes, especially when it's for a loan.
So if you like what you hear, give us a thumbs up, put a comment, let us know what you think. We love all the comments, we love all the feedback.
Yep, and as always, remember, your manners will take you further than your money.